Hey guys, Sean Bougie, surplusfundsriches.net. Bank of America is about to launch zero down, light, or no credit check loans. The purpose of this video is to give two alternatives to banks that make more sense and avoid setting people up for failure like we did in 2005 through 2007 with the craziness where anybody could get a loan. If you had a heartbeat, you could get a loan. Make sure you watch the entire video. I'm going to say the first alternative is the best, but you really want to check the second. The first alternative is simple. Let the market determine affordability, guys. Even a 10% correction would have zero effect on any home purchased prior to 2021. I'm going to put a link right now in the video I did on house values over time for reference. You'll be able to see where the major uptick came in 2021, and as a result, even a 10% correction is not going to affect anything prior to that because of the major increase in average home sale during that time period, okay? Now, the first alternative, again, is let the market determine affordability. The government is the last group that we should ask about fiscal responsibility or policy. They have not had a good history. And in instances where the market has been allowed to determine the value, rebound has been quicker. For instance, Florida in 2007, 2008, what they did is they continued to have tax sale foreclosures and they just ripped the Band-Aid off. And as a result, their property came back up quicker than a lot of other areas and continues to rebound strong, even as a lot of areas right now are starting to see a correction. But hold on, for those of you guys that can't help yourself, and you think we've got a meddle in the market, let's talk about the second alternative, and I would love to get your input on this. Here's the second option or alternative that I see. Guys, allow banks to make existing loans assumable if the buyers qualify with both their credit and their income. Also encourage second loans or equity lines, HELOC loans, if you will. Let me go over that again. Allow the banks to make existing loans assumable as long as the buyers qualify with credit and income. And I'm going to get to why this would actually benefit the banks. Of course, it's going to benefit the market. But let's assume someone bought a home, okay, for $375,000 that is now worth $450,000. Okay? So if we have a buyer come along and they want to buy that property that's worth $450,000 from that owner, they put $25,000 down, they pay 6%. It's actually closer to 5 3/4 right now, but 6% interest. Their total payment, principal, interest, taxes, insurance, is going to be approximately $3,424. Now, that's going to change from area to area, so don't slam me on that. But $3,424 a month. So let's give the alternative. Let's assume that they can assume that $375,000 loan. Guys, let's say that the purchaser prior to them bought it just a couple of years ago, all right? And it takes 5 to 7 years to start actually getting into principal because they front load interest. So let's say it's right around $375,000 still, okay? They assume that at the 3% the past owner currently has in place. And they take a second loan for $75,000 for the difference. They're still putting down $25,000 on that first, okay? They're going to pay $2,204 a month for that $375,000 loan they assumed, and they're going to pay $443 for that $75,000 loan they assumed. $2,607 a month, a savings of $817 a month. Here's what this accomplishes, guys. It would address the affordability issue dramatically. Monthly, dramatically, $800, over $800 a month. That's a big deal. It would also address the ability for the buyers to qualify because the bank's going to look at your income, your pre-tax income, multiply that number by 40%, your pre-tax monthly income, multiply it by approximately 40%, and that's how much you can spend on a home. Now look, if you also bought a Lamborghini and you had a $1,000 payment, they also look at the total debt you have, and there's a max on that too, so that would impact you. But bottom line is this. You got no car payments. You're trying to qualify for this house, okay? For $34.24 a month, you need to make approximately 8.5K a month pre-tax. Okay? That can be both people in the household. That's 100 grand a year pretty much. At 2607 a month, you need to make about 6.5K a month pre-tax. That's a $24,000 difference a year in income. You think more people will qualify when they're allowed to assume that first at 3 and then pick up the second at the current 5.5, 7, or 6%? Absolutely it would. $24,000 in income, this is going to make it a whole lot easier for people to afford it, not only on a monthly basis, but to actually qualify for it. It would break the vertical lock on the market too, guys. And I haven't talked about this in the past. That is part of what is keeping inventory low right now. 3.3 months is still low. 3.3 months of inventory is still low. It's still a seller market. What I mean by the vertical lock is this. This is keeping this dramatic increase in rates, doubling pretty much, is keeping the people that own a large home, maybe they're older, they would have scaled down, moved down into a smaller home. They're not going to do that. The reason they're not going to do that is that lower home is going to cost just about as much as their current home. So they're like, forget it, we'll stay where we are and have a larger house. But if they were able to assume that lower loan for that starter home, let's say, or step down home, they would make the move. So you get rid of this vertical lock that is currently existing on the market. That's also why people in starter homes are not moving up to higher ones, because the difference in payment is insane because of the higher rate. We could eliminate that by allowing mortgage assumption, as long as the people qualify both in income and in their credit. It would also offset the coming tax reassessment payment increase that's coming, guys. Taxes are about to go up on property. Just allowing people to do this would help them offset the difference in the taxes that they're going to be paying on a monthly basis. Again, mortgages include principal, interest, taxes, and insurance. A couple other points here. Buyers could attack that second line, that second equity line or second mortgage, because there's lower payments there. Without refinancing, they could attack it, guys. They wouldn't have to refinance this later. They could get rid of that second. If they paid an extra $204 a month, about a fourth of the payment savings, okay? The payment savings were what, $817? About a fourth of that. If they were able to come up with another $200 a month, they would pay off the second in 14 years and 3 months. That's a big deal. Banks could still charge an origination fee for the assumption of the loan, and they're still going to check credit and all that. They're going to get a lot more business because their refi business has dried up. So this just makes sense to me. Now, what this will not address is the new construction is still going to lag because the cost to build, the higher rates is going to impact them more than anybody. And your municipality limits, they're not issuing permits like they used to. With tax reassessments, the lower end will still get hammered with foreclosures. We can't fix that. So these are things that won't be addressed here. However, those foreclosures will get swallowed up quick with the demand. We know that already. It may actually result in lower rents because buyers look at rent versus cost to buy. So it hits a tipping point in favor of buying if rents continue to go up. So if they've got it's easier to buy, that's going to put a little downward pressure on rental prices. It's an interesting scenario how this thing could play out. I really like it, but I'd love to have your input.